All right, well, welcome for coming out on a snowy night and seeing our new webinar and in-person seminar. So tonight, what I want to share with you are some ideas on how to shift from an accumulator of wealth, which all of us are as workers, into getting ready for retirement and to convert those portfolios into income generation. So we're going to give you some ideas, and the folks that are here that are in our 401k plans, we've mentioned that we have a vehicle called a PCRA account, or an account that you can add on to your 401k that would allow you to start to step your portfolios into these income generation portfolios. And for the rest of the folks that are individual investors with us, we're already starting down into this pattern of income generation. So we'll step forward here. So the goals are, we're going to cover the risks of retirement planning, some of the tools that we use to figure out the proper lifestyle for retirement, then how to transition those portfolios, and efficient income distribution. This is actually what drove us to have this seminar. We had one of our clients early retirement and had no idea how to start actually taking the money out and living in retirement. So we decided we would help by having this seminar. And then effective tax planning. So you do want to determine how you're going to pull that money out to, as a retiree, pay the least amount of taxes. So we're going to help you on that too. So the three planning risks of retirement that we all have are, the first is withdrawal risk. We're all fearful that we're going to retire in, like, for example, 2008 when the market went really down deep. But we have tools that kind of take some of that volatility out of it. So we'll talk about that. The longevity risk. We don't want to outlive our assets, so we need to figure out the proper lifestyle before we go into retirement so that we do not deplete our resources before we become angels. And then inflation risk. As we go into retirement, we start out at one lifestyle, but we need to think about what happens to that dollar over time. It erodes because of inflation. So we'll show you some slides on that. So the couple that we're going to study tonight, we just picked Chad and Linda, and these folks are 60 years old, both of them, and between them, they both worked different jobs through their lifetime, and between them, they made just under $100,000. They were living on about $100,000 a year. And Linda worked in the school system, so she had a pension that would pay 50% of her salary at 65. She was in a 403B, and she had an annuity. And then Chad was an accountant in a company, and he just had a 401k with a decent match. And other than that, they had a little bit of inheritance and their Social Security. So if you add all this up, they had approximately $1 million as they were getting near retirement. So the first thing we need to figure out is the lifestyle in retirement. So the tools that we have, one is called Monte Carlo simulation, and the other is gap analysis. And the gap analysis is on most of your retirement calculators right online. So if you have one of our 401k plans, the gap analysis is on there. But it basically is just trying to figure out the shortfall that you might have right now as a saver in your savings versus what you want to meet as your retirement goal. And the rule of thumb has always been, as you begin retirement, as you begin your first job, you want to always start saving about 10% of your work wages. And if you do throughout your working life, then you do have the likelihood of a successful retirement. So that 10% number is still a pretty good number. The goal of a fully funded retirement plan that most, I would say it's the average nationally, is you want to target to replace 70% of your final average compensation. including Social Security. And then retire as near as possible to your full retirement age. And then invest with the least amount of risk to meet those goals. So remember that 70% is kind of the number that everyone uses to figure out a successful retirement accumulation. How much will you have to accumulate? For every $1,000 that you want as purchasing power as a retiree, and this is beginning at age 65 and living to be 90, this pool of money approximates what $1,000 per month as you go through your retirement life will need. So what you do on this chart is if you take your age today and then go across, approximately that pool of money is what will afford you about $1,000 per month of purchasing power. Now that includes inflation throughout your retirement years. Now this shows a Monte Carlo simulation, and I believe this is one of the handouts for the people that are here in person. For the folks on the webinar, if you're interested in getting our handouts, just email me afterwards and we will send them to you through the email. But this is what the output looks like of a Monte Carlo simulation. And what it showed is the beginning savings, which is in the top center, shows that their beginning savings has about $1 million. And the right hand is the income goal, which is the $68,000, which is 70% of their lifestyle. And then the yellow bar that runs down the center is simulating what the retirement withdrawal would be each year as they go through retirement, including inflation. So you can see that a couple starting with a goal of $68,000, when they actually retire at 66, full retirement age, they're actually going to draw out $76,000 because inflation has occurred. And then every year thereafter, it's going to slowly increment up until when they're in their 90s, they're pulling out about $187,000 per year. And that's what represents the inflation through your retirement years. So it's very key to have one of these done, and a lot of people have this done to figure out this right-hand column. What do I have as my lifestyle and retirement? What should be my retirement goal? And then the ones that meet with us early enough were able to figure out this annual savings, which is in the far right column. This couple we figured out in order to meet that goal, they had to save $16,000 those last few years before they actually retired, in order to start their retirement comfortably with about $1.2 million in here when they actually start retirement. So some retirement thoughts that we like to gather these. You want to have a goal to be debt-free before you do retire. And America's gotten away from that thought, but we're kind of coming back to that because over half of the retirees surveyed were not debt-free. And it really makes it difficult to plan to handle a large mortgage payment as a retiree. The other thing is the safe withdrawal amount out of all of your pots of money would be 4.3%. That will make sure with the volatility that's been in the market growth and so forth, that you don't deplete the pools of money that you do have. So 4.3% is kind of a safe withdrawal amount. Diversification, I'm a proponent of that. Over the last 50 years, from 61 to 2011, the S&P returned 9.7%. But if you miss 50 days of the best market days, so roughly one per year is the best market day, then your return is only 4.5%. So the key here is to diversify while you're a saver and ride through those markets as best you can to not miss those best days, because you'll miss the up. And those are very key to that top return there. And then health care savings for retirement. Fidelity does a study each year, but they released a married couple for last year, this was 2012, a pool of about $230,000 is what they are expecting you will use for health care needs and retirement. So buying power. Inflation has increased the level of prices in the U.S. 64% over the last 20 years. So what does that mean? That means folks that retired in 1990, so that was roughly my parents back then, on a fixed income, they would have only 61% left of that purchasing power if they had not planned using like a Monte Carlo simulation, which includes inflation. So it's very key to do that planning ahead of time, and that means about 40% of the purchasing power has been lost just since they started as a retiree. And especially now, if they're trying to, stay invested in CDs, it's very difficult. I mean, the interest is so low for retirees. Now, Social Security is another key planning tool as a retiree. And we have several scenarios here that I'm going to show you. But there's something called a spousal benefit that I want to talk about. So there's kind of three ways that you can draw your Social Security. You can trigger it early at age 62, or you can wait till full retirement, or you can let that age out and apply at 70. And all of these are different levels of Social Security. The one that they plan on and everyone talks about is your full retirement age. But you can go early and you can go in times in between there. And then it actually accretes or gets larger if you wait till 70. So we're going to show you Chad and Linda here, an example. This is a 60-year-old couple earning about $100,000. And these are the three scenarios. If they took their benefits early, so let me think. This is first a 60-year-old. So this is one person earning $100,000. If that person triggers it at 62, they're going to get $18,084 in today's dollars. If they wait till full retirement age, it's roughly $25,000. And if they wait till 70 to trigger it, then it's about $34,000. So you can see the significant difference there in waiting. The spousal benefit that I mentioned for married couple is the spouse is able to claim on the other spouse. And what's interesting is you should have a study done, what is the best combination if you're a married couple going into retirement. And we're going to show you the Chad and Linda situation, and it's rather, it's probably different than what you would surmise. But utilizing the spousal benefit at different times can affect your Social Security and greatly improve your lifestyle and retirement. So Chad, as you'll remember, is age 60. He had a salary of $67,000, and his full retirement benefit is $22,000. And Linda also worked a little bit. She had a salary of $26,000, and her full benefit is $13,000. So if they both trigger at full retirement age, at age 85, that $22,000 and $13,000 would be giving them a $70,000 income. Okay, and if they utilize the spousal benefit, then the second and the third case take place. So what happens here is Chad files for his full retirement, and Linda files for a spousal benefit on Chad because they're both the same age. Okay, so this is at 66. Chad is going to take his at this $22,000. She's going to only take a spousal benefit, which is half of his. And then at 70, she's going to switch to her larger amount. So here's where she's utilizing that spousal benefit on Chad. At 85, that would allow another $8,000 because she waited, in essence, and took a spousal benefit. Only took half, and then she waited and let hers age. So that's another $8,000 at age 70 on. Now this is the flip, where Linda files, the third one. Linda files on her record at full retirement age. So she's going to start taking that $13,000 at 66. Chad is going to take a spousal benefit on Linda's. So he's only going to take half of that at age 66 and let his age till 70. And then he's going to switch to his larger amount, which was, I think it was about $30,000 at the time. So at 85, that would afford them a salary of, or for Social Security, of $84,137. So that's a little bit larger. And then the largest is if they both wait till 70 and take the increased benefits. That still would allow Linda to take a spousal benefit at 66. So she'd get a little start, but they in essence would then have the larger benefit. So then it would be $92,000 from 70 on. So what's most appealing here is the third case, where you're retiring at full retirement age, you both start taking some Social Security, but you have Chad only trigger the spousal benefit and let his get larger and wait till 70. So we're going to utilize that case and show you how we would plan around that. So that $84,000 is what they'd be drawing at 85. So as you get into retirement, you do need to determine what portfolios you have. So we're just going to show you. I used the theme here of the leprechaun and pots of gold here. So a lot of us have 401ks that we can save in. Some have Roth IRAs or traditional IRAs that you've built. Brokerage savings is additional savings outside of your workplace. Some have inherited some funds. Of course, we all at this point have Social Security. Some have pensions from their employer, and others have bought annuities. So all of these are items that need to be included when you're thinking about setting that lifestyle for retirement. So the goal is how to transition all those pots of money and convert them into income producing. So what I'm going to show you here are all different types of assets that we recommend considering as you convert these pools of money into income producing. So most of us have the second one, which is mutual funds. We start out with mutual funds at Savers, and usually those are introduced to us in our employment. Our employer has mutual funds. That's usually the base that you start. And then all these other types of assets, fixed income bonds, high dividend stocks, covered calls, master limited partnerships, structured CDs, preferred stocks, and muni bonds can be added later. And we do recommend a certain way of stepping into these different assets. And the last is commodities, the gold, silver, and agriculture. So all of these are different assets that will certainly help to increase the income. So the first is the fixed income and bonds, and I want to spend a minute on this. The bond market right now actually has more risk in it than the equity market. And the reason being is because bonds, right now on the short end of the bond curve, it's zero. The federal government has taken the bonds to zero, and that's why CDs and banks are paying virtually nothing if you put your money on deposit at a bank. So what's going to happen is the government, as this economy recovers, they're going to raise interest rates. And when they do that, the bond market gets harmed or gets slammed because the face value of bonds are going to fall trying to keep up with the increased rate of interest. Because many of these bonds were issued in the low interest rate environment. So the key as you're getting close to retirement is to convert the bonds that you're holding in mutual funds into actual bond holdings. You want to actually buy the bond. Because when that interest rate market switches, which it's likely to do in the next 2 years, if you hold the bond, then you will hold that bond to maturity, and you won't get harmed by what's going to happen with interest rates. So this is a key item to think about. And what we do for retirees is we create a laddered bond portfolio. That's what you want to start to think about.
You talked about it. When you say bond, you talk corporate bond, you talk to any bond.
Any bond. It's safer to actually own the bond. Like if you want to buy Bloomfield Hills Muni Bond, you want to buy that and not buy Muni Bond mutual funds. Because they will flip that. The mutual funds will start turning those bonds as soon as those rates go up, trying to buy the more expensive paying or higher interest paying bonds. So they lose money. But if you actually own that bond, then you will hold it because you like it. It's paying 4 or 5%. And even though the face value might fall a little bit when that interest rate changes, when that matures, if you believe in Bloomfield Hills Muni Bond, that it'll be there, it'll pay you the face value. You won't lose a dime. So this is a very key point I did want to make. That's why I put it as number 1. And that's what that says here. Actual ownership of bond reduces the risk during retirement. Muni bonds. These should be used in brokerage accounts, savings accounts, because municipal bonds are exempt from federal income tax, most of them. There's always a few that aren't. But we hunt for the ones that are federal tax-free. And a lot of them, if you buy them in the state that you reside in, then you get the state tax exemption also. So all of the interest that you earn on muni bonds can potentially be tax-free. So that's something to think about also as a retiree. Now, mutual funds. This is where we all start, and the bulk of our savings are in here. And a lot of people, when they come to meet with us, they come in and they got account after account after account, and it's all mutual funds. So the first thing we do is we do a study of those mutual funds, and we use a tool called FI360. It is a deep research tool that looks at 11 different parameters of mutual funds. And most all of you that are here tonight, we have done this in your portfolios. But basically, it does a fiduciary score, and it ranks the mutual funds. We can very quickly tell the better performing mutual funds. And what we're trying to do is locate mutual funds in this top quartile. So we want them to have a green, a dark green color, and we want them to have a fiduciary score from 0 to 25 or less. And if it's anything less or greater than that, then it's getting more to the median, or it's in the bottom quartile and so forth. So we're going to look to replace that. And this is a typical mutual fund FI360 when folks come into us. This is someone that brought in a mutual fund portfolio just a couple weeks ago. And you'll see it has yellow and lime green and red, and it's very colorful. Lots of red X's. Those red X's are failures in the fiduciary score. So this tool is very visual, and you can tell very quickly if you have a good, healthy mutual fund portfolio or not. Now, folks that are invested with us or have our 401ks, that's how your mutual fund portfolio looks at your company. Dark green, all in the upper quartile, you know, top of their peer group. So it's a healthy mutual fund portfolio. Our selection process here at Foresight encompasses many tools, but the one that I just mentioned was FI360, but Morningstar, that can look at all of the annuities. It can look at all the mutual funds in the world, international and domestic. Standards & Poor's has a tool called Market Scope, and we use that to analyze stock holdings. So when we set up a high dividend stock portfolio, we're going to use that tool to, again, flag if we have a good stock or not. And BrightScope's used to look at 401ks and different plans that we might be looking to help. So a Foresight moderate mutual fund portfolio, this is what it would look like. Some key things here are in yellow. We're looking at standard deviation, which is the overall risk of the market. And we want something that's going to reduce risk. So our portfolio would have about 11 when the stock market would have about a 15. And we would have alpha, that says 3.46%. What that means is it's adding extra return to your portfolio over what the market has returned. So that's another sign of a good portfolio. Now, high dividend stocks. This is another thing to think of adding. The reason you might want to consider having some high dividend stocks as a retiree is just what it says. They pay a dividend. So it's every quarter or every at least a couple times a year you'll have a stock pay a dividend. And a lot of retirees like to live off of those dividends. And if the portfolio is put together correctly, you can get a high dividend stock portfolio paying, 5, 6, sometimes 7%. So there's some high dividend paying stocks out there. Covered calls, this generally works. It's a conservative strategy that you can add on to a high dividend stock portfolio. And I say generally because it depends on what the market's doing. If the market is in a growth pattern, which we are right now, and it isn't zooming straight up, but it's just gradually slow growth. So it's kind of what we've seen the last couple of years and what we expect the next couple of years. Then covered calls can be written on top of owning the stock. And it's a way of gleaning extra premium or earnings on top of actually the dividend that you would get from the stock. Master limited partnerships. These tend to be infrastructure, and they focus on items in our country that are such as oil, gas, coal, storage of our fuels, toll roads, shipping, and pipelines, to name a few. And they pay out high income, averaging over 5%. So this is another thing to think about as a retiree. Again, it's not a dividend, but it's paying you an income. What's neat about them is they have a unique tax structure. And what they are is, because they're a partnership, is you will invest in it. So let's say you bought $5,000 of a master limited partnership. It will start paying you 5.5% income every year. And that income you will have to claim on a K-1. So you get a K-1 instead of a 1099. So you've got to put that on your tax return. But you will not pay any tax on that until you have recouped your $5,000. So it takes numerous years, lots of years in fact, to get at 5.5% your $5,000 back. So you've got sort of this way delayed tax structure. So there is, in other words, you have to recoup all of your basis before you have to claim income tax on it. The reason we like looking at master limited partnerships, and this is a picture of the U.S., and all those pink and peach colored areas are where they have found oil reserves, gas, and so forth. And you'll see there's a lot of them. So this is going to be a growth area, I believe, untapped, but a lot of it's being tapped, but to come in our nation. And you'll see Michigan doesn't, you can't even see the mitt. The whole thing is covered. So Michigan is a very fruitful area right now for oil and gas. There's a lot of research being done here, and seismic studies and so forth. So I think our state is going to be one of the talked about areas to come. Again, master limited partnerships would be the type of investment there. Now, structured CDs. Why do we like these? because CDs right now in banks are paying virtually nothing or very little, maybe 0.5% if you're lucky. A lot of them are less than that. But a structured CD is tied to a market index or a basket of stocks. So when you have the market rising, and the bulk of the equities are rising right now, then if you can tack your CD on to how the market moves rather than what banks are paying you, you have a chance to earn more of a market return in a CD environment. So you still have FDIC insurance, which is nice about these. But you will get to say, I want a structured CD, but I want it to be tied to the S&P 500. So you will buy the CD, and it will be a longer-term CD. It might be for 3 to 5 years. Just it's a longer-term CD. But you'll say, okay, where's the S&P today? And then every quarter it will look, is the S&P higher or lower? If it's higher, you get the interest it earns. So if the S&P rose 2%, you'll get 2% on your CD in 90 days or in 1 quarter. If the next quarter it goes down, a lot of these will not pay you anything, but you won't lose. So it'll average out your 4 quarters, and it will say, okay, what is the average? If you earn 2, then 0, then 4, and then 4, you get 10% on your CD that year. A lot of them also, if let's say the next year, year 2, so you got 10%, you really won that year. Now the next year the market went down. You'll get 0 that year. Okay, but if you average it over 2 years, you're in 5% on that CD each year. So now the 3rd year comes by, and so forth. So it keeps looking at where that market's at, and you get to ride kind of the market with your CD. So these are nice. We like to put people in these CDs when the market tumbles a little or it falls. And again, they're FDIC insured just like you were at a bank, and up to $250,000. Preferred stocks. These are popular right now. A lot of companies are issuing preferred stocks. Since the fiscal cliff settled and gave the dividends benefit over interest, folks or companies that need to raise money are issuing some preferred stock. Now, what's different about them? Preferred stock pays a dividend that it's just what it says. You are preferred. You will be paid your dividend before the common stockholders are paid their dividend. So you have preference. And they are sought after. We get called weekly with the ones that are coming to market, and we have been able to purchase several of our clients into these preferred stocks in the course of January and some in February. But they do pay a nice dividend. A lot of them pay over 5% on the preferred stock dividend. And the last is commodities. I do believe, portfolios, even as a retiree, should have some sort of commodities in them. Just as it's a great hedge against inflation. I do think we will see inflation coming into society. It always does in an economic cycle. When we come out of the growth state and right before the Feds raise interest rates, the demand on the markets will create the inflation. So having some gold and silver in the portfolio is smart. So what does this show us? This shows us a typical asset gatherer's portfolio. So this is the Chad and Linda when they came to us with the mutual fund portfolio. And they have, in yellow, the standard deviation. Doesn't look too bad. It's at 10 versus the market at 15. So it's kind of in a moderate state. But typically, they'll have a combination of mutual funds on that alpha line that are, see how it's negative 0.3? Alpha is the excess return that portfolio earns over the market. This one actually is lower. And that means that pool of assets is taking more risk than it's paying you back in return. So that's why that FI360 research tool is so important to keep even a mutual fund portfolio healthy all throughout your investment years. So what do we recommend? If we took that $1 million, if you said, hey, I want to have this invested, I'm getting ready for retirement, we would recommend right now about $317,000 in fixed income, $220 in moderate mutual funds, $150 in convertible bonds, $120 in high dividend stocks, $83,000 in preferreds, $80 in ETFs, and $30 in master limited partnerships, and that's the $1 million. Now, what does that mix do for you? So what we're going to show you here is some of those statistics. Okay? This is what it does. The standard deviation gets cut even lower. It's down to only a 6% volatility against a market that's going to be volatile up to 15%. So as a retiree, you're going to sleep better at night knowing that things are only going to move about 6% or 6.5% each way versus losing 15% of your money. The alpha is 6.75%, so that's adding almost 7% extra income over what the market's going to produce if you were just in straight stocks. And your beta is, again, a third of the market, which is roughly what that 6 is showing. But beta is 0.37, very low. That is a retiree style of investment. So if you look at these two from a cash flow standpoint, because that's what retirees are interested in, how much projected cash flow if I just wanted to live off the income off of those. So the far left one there, the projected cash flow of the mutual funds only is $19,000. And then you'd have your Social Security on top of that. This portfolio has a projected cash flow of $54,000, much higher. So $35,000 more just in income and dividends by restructuring it. And then distribution, how do we recommend? If you're going to retire early, and a lot of folks do, this would be the order of extraction or distribution that you would take out. In the early years, you're going to be relying on your brokerage savings heavily. And then you're going to also rely on 72T IRA calculations. So this is for people that are going to retire in their 50s. Before 59 and a half, you would have to do what they call a 72T calculation on your IRAs. And if you had us do that, or any time that you want to take money out before 59 and a half, then you can avoid that 10% penalty. Okay? So that's a very key thing for early retiree to think about. Then the pension would kick in at normal retirement age, usually 65. And your Social Security, we would recommend trying to hold that off and try and wait till your full retirement age. Maybe use some of that spousal benefit. And then your annuities would be used as soon as your brokerage savings was used up. And then eventually your required minimum distributions would kick in and your 401k at the end. And the Roths. The Roths are always your last money that you want to use. Then at full retirement age, you would kick in this order. Oops. Okay. Retirement at full retirement age. Your pension would start. The Social Security would begin. You might, again, use a spousal benefit there, but you would kick in the Social Security. The annuity would be used. And then your brokerage savings would be filled in as you had shortfalls in that lifestyle. Eventually, at 70 and a half, your required minimum distribution begins, and your 401ks and IRAs are tapped. And last is your Roth. Now, we're going to move Chad and Linda's brokerage, or their savings pool, from 60 to 66. So they implemented our Monte Carlo savings. They saved the extra $16,000. And now they're at 66, which is full retirement age. So this is what their pool of money is now. It's about $1.2 million, and they are ready to jump into retirement here. So how would we begin to plan out how they're going to take their money out of these pools of money? So the first thing is we laid in here, in the yellow, the Monte Carlo. So as you remember, at 66, it started about $83,000, and it grows up to needing about $182,000 at the end. And then their pension kicks in, Social Security, and the annuity. But we have this peach item here, which is the shortfall. Because between the pension, Social Security, and annuity, they still need about $46,000. So what would we do? We would start to tap the brokerage money, because they had about $200,000 saved, in those early years to make up that lifestyle in retirement. And in the middle here, we would start to tap into the required minimum distribution, which is the green. That's when they're 70 and a half. And then once that needs more money, then we would come back to this brokerage savings and eventually the Roth if needed. But the way that their Monte Carlo ended up in their 90s is they still had about $500,000 left, and that's where the estate planning would happen for their heirs. And that drawing out or extraction of the money would create the most effective tax planning. So in their early years, again, this was full retirement age though, their effective tax rate ended up about 6%, the way we took the money out of that. And then it grew to the 24% for the bulk of their retirement years because they had to take that required minimum distribution out. And then towards the end, it tapered off a little bit. So again, you want to try and think about taxes as much as possible here. And that's, again, as we said, the bulk of the income comes out of after tax in the early years. Then you only move to required minimum when you have to. And then at the end, you come back to your brokerage savings or your Roth 401k or IRA. Pension taxation, I want to mention this. We did get a confirmation from the state of Michigan because the state of Michigan now taxes public and private pensions. And this is something really to think about. I think, Ron, you mentioned it too. We also. Before you retire, and if you are a Michigan resident, it is smart to be thinking about finding a state that has zero state.
Welcome to state.
Yeah, I mean, it's crazy, but it's true. Because if you then have a pension that's going to come from a company in Michigan or an organization that you work for, you will pay zero taxes if you live in one of these states. Texas, Alaska, Florida, Washington, New Hampshire, Tennessee, Nevada, South Dakota, or Wyoming. You could, but you got to claim residency. The key is residency. It's got to be in that one of those states.
That's how most of the people go to Florida and live over here, over there, and claim residence in Florida because you don't have to pay state. Okay.
Right, and you're going to save 4.3% on that pension. That's something huge to think about.
Right.
So, I just wanted to mention that, and that's a lot of people out. This is starting to get out, but I mean, they have to really think about that if you have a pension. At the end here, I want to share with you the economy. You know, where are we at in the cycle? This looks like a cloud, but the cloud has some key data in it, and it's really the historical cycle. Every historical economic cycle has played out just like this. And where are we? We are in the top of this. We're kind of coming over the top of that cloud. But if you'll notice, in the little circle in the top here, it's called a positive feedback loop. And all of the arrows are up. See how they all point up in that little circle at the top? And what those arrows are is, the first is non-farm payrolls. Okay, that is the unemployment rate. And it says it is reducing, or it's positive. Okay, so it means unemployment has to be reducing. So that's positive because we're expecting unemployment to go from 7.8% down near 6% by the end of this year. The Y is income growth. And that's positive right now. The C is consumer spending. Consumers are still spending and buying. Cars are up and houses are being built and so forth. And CP is corporate profit. Now, let's See, we have a little typo there. But the corporate profits are up. Over 75% of our companies, the S&P 500, reported positive earnings or beat estimates in January. That's why the market lifted so much in January. Kind of surprised everybody. But what happens when we come out of this? I just want to show you where we're at. We're up there. We're in the positive feedback. And they're expecting that to happen and continue to spiral for the next 2 years. What's going to happen after that in about 2015 and 16 is we're going to come down to this I, which is inflation. And inflation is going to start to rise because we've added so much money supply. Then R is going to kick in, and the feds are going to get involved, and they're going to raise interest rates. And that's when I told you risk in the bond market is when that happens. So you've got a couple of years to think about how to position your fixed income inside the portfolios, because that will harm them. Then we spiral into this negative feedback loop. We go back into a recession or a downtime in the market. Hopefully they're expecting this next recession to be mild, but don't know until we get there. And then it just will, history repeats itself. So the positive news here is that we are up in this upper portion. We're in a positive feedback loop, probably for at least the next 2 years. And the feds are helping inspire that because they're keeping interest rates at 0. And the other interesting thing, and I've heard several economists repeat this, every time unemployment has lowered from 7% to 6%, just since the early 1900s, the S&P 500 has risen 20%. And every time unemployment has lowered from 6% to 5%, the S&P 500 has risen 16%. So the likelihood of a positive market the next couple of years is quite high if that occurs again. So we are thinking that, be invested in the stock market. Right now it's a little high. It roared up here in January, but definitely buy back in on those dips and get positioned and then ride through these next couple of years. So the economy, I'd say the market is going to increase over the next 2 years with slow GDP. The bulls are here to stay for a while, and certainly stocks or equities are going to outperform fixed income. Interest rates will stay low, and that's what's fueling this economy and getting people back to work. The banks are beginning to lend money. That's positive. The debt crisis is starting to resolve over in Europe. Oil is likely to increase over time, and commodities eased a little bit because of lowered industrial demands. I think it's just a minor little blip. I think oil is going to increase. This is the star where unemployment is definitely moving in a positive way, and it's lowering. We're getting closer to 6%. And inflationary pressures will stay at bay, except we see some price increases in food. These are the areas we see the most opportunity right now is real estate, health, financials, and tech. Fiscal cliff did not weigh that much on the market. And again, we had a positive effect here in January because of the earnings that the companies had. And retail sales are improving. This is the Cyber Monday. It hit $1.5 billion. Again, the consumers are spending. And then the BRIC nations, I want to say these are foreign investments. Even though you get, scares on the news and stuff that China's coming to a screeching halt, it isn't. It's just slowing. Instead of 10% growth, many of these nations here abroad are earning between 6 and 7%. I mean, they're doing a touch better than the U.S., quite a bit better. So we expect the same type of growth in 2013. And then the only other thing is, as retirees, you do want to think about gifting. Again, that estate planning, that's another thing that has to be considered. So thank you for attending. I hope you all took something good away from this, and you might have some questions at the end, but thank you certainly.